What we wanted to do today really was just talk through changes that some were announced a year ago but are just kicking in now. Some are more recent in the budget we've just had in March. But it's just to really go through all of those and help maybe clarify any myths that you might read in the papers or answer any questions that you've got. By 2020, HMRC say that everything will have changed, and this is for individuals, but also any business, whether it's you're in a partnership or company, and whether you're property letting or doing anything else. Everybody is going to move to a different reporting regime, which is all designed to be more up-to-date, real-time, using technology. And it will mean the end of the annual tax return, so no one will have to do it anymore. But instead, you'll have to file quarterly. Not a full tax return quarterly, but you'll have to file something quarterly. So for landlords, we're expecting this to kick in April 2018. This is when we're expecting this to start. So the first tax year, where there, in theory, won't be a tax return, will be the 2018-19 tax year. It is frustrating when HMRC have so much information, but you as a taxpayer have got to go out and get it all and file in the return. So they know exactly what people's salary is, they know exactly what benefits they get, they know exactly what bank interest and investment returns you get, because the banks have to tell them all. So all of that is apparently going to be done for you and put into your online account. Now, but of course, there are things that they don't know, which are, as we show there, landlords, for example, they don't know what your profit and loss is. So that's where the pressure is going to be. It's going to be an obligation on everybody here to upload quarterly into their system, however it turns out to be, what your profit and loss is on a quarterly basis. They're encouraging, if not forcing people, ultimately to go down the line of no more spreadsheets and things like that, but to use a system which is capable of interfacing with HMRC's computers to submit this quarterly. So whether, obviously an accountant will do that for you, but if you're doing these things yourself, you might have to change the way you're doing your record keeping in order to be able to comply with this. Now, at the moment, there's no suggestion for HMRC that this will mean quarterly tax payments to match your quarterly returns, but you know, I wouldn't be surprised if that's the way this ends up going. Okay, so SDLT, as we all know, we've now got an extra 3% charge in most cases on purchases of second homes. It applies whether it's an individual purchaser, a company purchaser, or whatever medium is the purchaser. We've got some exemptions for houses under 40k won't have to pay this. Property that is commercial or part commercial may not have to pay this. And there's also effectively a carve out for people that are just moving home from one main residence to another. We were going to have a specific relief for bulk acquisitions above the 40k level. That's what was proposed when this was first announced in November. That's gone away, so there's nothing there for that now. And unusually, we also have no relief for furnished holiday lets, which tend to get treated much better for tax purposes than most things, but not this apparently. And there's a little example at the bottom there of how you work it out. So the 3% charge is just applied on the entire value on top of what the bill would be under the usual rates. So, as I say, there's a carve out when you're just moving house, so this extra charge won't apply. Where you're in the situation that you buy your new house before selling your current one, which happens sometimes, you're actually going to have to pay the extra charge and then claim it back, which you're allowed to do so long as you sell your current house within 3 years of moving to the new one. Is for people that have two homes that they split their time between, and that could be a home abroad in here, they have a holiday home, or it could be the seaside flat and the house they live in. For other taxes, you have the ability to elect to say which one is actually your main home, when you've factually got two houses that you split your time between. With this, you're not going to have that. Apparently, they're just going to say, based on facts, which one is your main home. That will just throw up lots of confusion, because you could end up paying SDLT on a house which doesn't follow the same that you're electing for capital gains tax. So overseas properties will count for this. Of course, if you're buying an overseas house, then UK stamp duty is irrelevant. Whether they have stamp duty where you're buying, that is another question. But where it's relevant here is if you've got a UK house or foreign house already and you're buying a UK one, then that's a second house. The fact that the other one's not here doesn't matter. You're buying a second house in the UK. And parental ownership will have to perhaps change. So what I mean by parental ownership is buying the house for the kids or helping them get on the ladder. A lot of people like to do that jointly with them, helps them get a mortgage. That is going to be a second home, because assuming that the parents have their own home, and therefore the only way around that is perhaps using some sort of trusts, or you simply instead lend the money to your kids and they buy as their house, but that requires you to have the money to lend. You had a furnished property. You used to be able to claim 10% of the rent less certain rates as effectively your depreciation and your need to replace furniture and furnishings in the house. That's gone now. Instead of that, you can actually just claim the actual cost of replacing furniture and furnishings. So, restriction for finance costs. So, finance costs means mortgage interest. It means other things as well. It means costs of finance to your business. So, your valuation fees, your mortgage broker commission, whatever costs you've incurred in raising finance for your portfolio. This is going to be restricted now for individual owners who are 40% or 45% taxpayers. So this will not affect people who are basic rate taxpayers. And it's not started yet. It's starting in April 2017 and being phased in 4 equal bits. So it will kick in properly in 2021. A guy owns just one buy-to-let and he's a 40% taxpayer through other income he's got. So one column there, 2016-17, that's what his tax calculation will look like this year. So he's got £2,500 of, let's say, just mortgage interest, and there's his tax there at the end of the year. 40% tax on the profit that he's making. Now in 2021, when the full finance restrictions in place, this is what his tax computation will look like. So nothing's changed here other than where the finance costs come in. So they don't come in near the top, they come in at the bottom, and because you're restricted to basic rate tax relief, what you get knocked off at the bottom is 20% of your mortgage interest. So on the left-hand side, you'll see his mortgage interest was £2,500. So 20% of £500, that's what will get knocked off his tax calculation. So his tax liability has gone up quite a bit there. This is an example of how this can play out for someone who's heavily geared on a larger portfolio. So again, this is a married couple, big portfolio, heavily geared. So again, 2016-17, that's what his tax comp looks like. Because of the other expenses and the amount of finance costs, he doesn't pay much tax because he doesn't make much profit. But in 2021, that is what his tax computation will look like if he's a 40% taxpayer. So it's by restricting the finance costs in that way, it means that his effective tax rate on the money he's made in his business is 156% because of the level of gearing and the fact he's a 40% taxpayer from other things. CGT changes, these aren't as important as the things we've been talking about, but in the budget, unexpectedly, the government actually reduced capital gains tax from its current 18 and 28% to 10 and 20. The difference between the two is whether you're a higher rate taxpayer or not, but except for residential property, so a bit disappointing. And then the only other thing that's on the horizon is that currently, if you sell a property, make a capital gain, and you owe some tax, you don't have to pay it until the January after the end of the tax year in which the property is sold. So that could be 18, 20 months later. That they're going to now put an obligation on the solicitors who now do your conveyance to collect the stamp duty or the capital gains tax or a big part of it at the time that the property's sold and the money's there and you've got to pay it over within 30 days. So they're just bringing the tax payment date forward. We've now got from this month, an increase in dividend tax rates, massive increase. So that's what the rates were, that's what they are now. So again, it goes up as your basic additional high rate. And all we've got to temper this change is, at the bottom there, the last point is, we now have a new £5,000 dividend allowance. I should say, obviously, this is not just property related, this is whatever company you are doing, whatever, this is the new rates. The background to this is that for years and years and years, the government haven't been very keen on what's called personal service companies, so the classic IT contractor, say 50, 60 grand a year salary he would earn if he was working for somebody, doesn't get employed by them, sets up his own company and the company invoices 60 grand a year. He basically looks like an employee, acts like an employee. But they've really struggled, the government, just to tackle that, taxing like an employee. They can't regulate it, they can't get the rules. So what they've done by doing this is basically just close the gap to almost nothing. You may as well just be employed with them now. Looking first at the annual tax on the profits. So what you have to currently put on your tax return or your corporation tax return if you're a company. Obviously, if you work out broadly your profit in the same way. Pay income tax if you're an individual, company tax if you're a company. Income tax rates, obviously, we've talked about already. Company tax rates have been continuously falling. It wasn't that long ago that they were 28%, and now in 2020 they were 17%. So that's the UK's corporation tax rate. So on personal ownership, we've been talking about this restriction on the relief for finance costs. That applies to individuals, not companies. So companies have no restriction. Okay? And then finally, obviously, if you're an individual, once you've paid your tax, that money is then yours. You have to pay tax on it, whether or not you extracted it from your property business or reinvested it into another property. So it's yours, and therefore there's no second layer of tax when you take the money out of your business and spend it personally. Whereas with a company, you pay your corporation tax. If you reinvest, it stays within the company. But at the moment you take it out, whether it's this year or 10 years down the line or whatever, there's going to be a second layer of tax to some level when you take that money out to spend it on personal things. But you are in control of the timing of that. And in the meantime, if you are trying to build a portfolio and you're reinvesting, you've got more money to do it with because the company tax is lower than the individual. So, little example. 100,000 income, bit of expenses, and this is looking forward to 2021. So this is when our restriction for finance costs is in place, and when our company tax rate is 17%. So on the left-hand side there, you see personal ownership. He will end up paying £24,000 of tax. The company will pay £6,000 on the same figure. Okay, so that's obviously a big saving annually, but don't forget three key things when comparing those two numbers. First one, again, second layer of tax on profits. Here, the person's paid £24,000, the rest of that money is his. There's no more tax, well, apart from if you die and pay inheritance tax, but there's no more tax on that money, it's yours, after tax money. Whereas a company, you've still got to get that profit out of the company. And we talked earlier about what the dividend tax rates are. That could well be the cost of extracting it. Second bullet point, additional finance costs. Is borrowing in a company more expensive than borrowing as an individual?
Yes.
Probably is. So, if again, coming back to our example here, yes, there's a nice tax saving, but don't forget to factor in your additional borrowing costs and what they could look like if interest rates rise. But thirdly, cost and complexity of managing a company. There is a bit of cost to having them, and it just adds a bit more complexity in your life, but not too onerous. So, if you think about the combination of those things, really what company ownership suits is people who are not living on their rental profit, i.e. because they're not spending the money every year on living. Because if you are, and you pay company tax and then you extract all the money out every year, it's basically the same outcome tax and just owning it individually. However, if you're trying to build a portfolio and this money is staying within your company for a long period of time, then a company becomes more attractive because the cumulative effect or paying less tax annually, even though you are deferring something for further down the line when you do extract it from your company. That can make a difference. So individuals pay capital gains tax. You have your annual exemption every year, which is about £11,000 at the moment. You don't get any capital gains tax allowance for inflation. Whereas if you're a company, companies don't pay capital gains tax, they pay company tax, which is corporation tax, again the 17%. And they also get an allowance for inflation, which, again, won't make a big difference if you're selling a couple of years after you bought, but over a long period of time, that can make a difference. And companies don't have an annual exemption like an individual does, which is important. A married couple have effectively £22,000 a year annual exemption from property sales, so you don't pay any tax if your gain is less than that. Companies don't have that, straight into tax. And again, this point about second layer of tax, if you ever extract the money. The answer to this is different for everyone. It all depends on your personal circumstances, what your other income is, what your rent is, what you're spending the money on every year. Are you spending it? Do you want to increase your portfolio, or are you just trying to accumulate the cash? The answer is different for everyone. So incorporating. So what I mean by incorporating is you have your portfolio in your own name, or you and your wife's name. What do you have to do to move that portfolio to a company? What are the tax consequences of that? Well, firstly, when you do that, you are disposing of properties. Whether or not any money effectively changes hands, if you're transferring it to a company, you're deemed to have sold it for its then current market value. Now, whether that gives rise to a capital gains tax liability at that point will depend on a number of things, like what your personal situation is, what the property values are compared to what you bought it for, etc., etc. That is simply the way it is, unless there's something called incorporation relief available. So incorporation relief is a specific capital gains tax relief that is designed to allow a business to move from a non-company status into a company. You operate a sweet shop as a sole trader, you can move that sweet shop to a company, no tax. The question is whether your business, your property business, is a business for the purposes of that relief. A sweet shop is. A passive buy-to-let landlord who owns a couple of houses, outsources all the management, doesn't do anything themselves, is not a business for the purposes of that relief, and they will not get that relief.
Have you had anybody actually get the relief?
Yes.
You have?
Yeah, to get it. It's not an easy relief to get. It's possible to get it, but it will depend on the circumstance, like I'm trying to say. And the line, there's no set, if you fall in this box, you get it. If you fall in that box, you don't. It's about evaluating the facts and trying to apply it to case law. And where people are close to the line, you can go to the tax office in advance of doing anything and say, my client is thinking about doing this. I think that relief is available because, do you agree? And then they will write back and give you a clearance. So that's always recommended in these cases. But the leading court case was basically a lady who bought a big property and converted it into a number of flats, and did a lot more than just a passive buy to their landlord. So they looked after the property, maintained it themselves, spent a lot of time on it, didn't have another job. It just looked and felt like business. Even if incorporation relief is in principle available, so let's say it's somebody that could get it, you've then got to think about implementation, particularly where there's mortgages secured on the properties you're trying to move in. So two of the conditions to get entrepreneurs relief is the whole of the assets of the business must be transferred. In simple terms, you own 10 houses, you can't move 5 in to get that relief, it's all got to go. Second, the consideration for the transfer is wholly satisfied by shares in the company and not cash. This really comes into play when there's debt involved. So you've got a portfolio of 5 properties each, one's with Mortgage Express, one's with NatWest or whatever, you've got 5 different mortgages. The bank, to move ownership, the bank are going to have something to say about that. They may well be perfectly happy to have their loan to a company, but it may not be. So, and you might say, well, a company can just raise a new loan to replace the existing ones. The way that you do that and the steps you take, you've got to be very careful, because if you move your properties in and effectively you get shares in the company in return for the equity, but then your new company has raised a new loan that is on the conveyance, pays off all the other existing ones, what you've actually got for your properties is part shares and part cash out of your company. So you've got a part capital gains bill. So what you need to do, if you've got debt, is get the lender to either say that they're happy to continue the existing arrangements within the company, or if they're not, because they might want to charge more or whatever, that's fine, but it needs to be the same loan moving in. What then happens once it's in the company, it can be refinanced or whatever later, and that's when the banks can charge more because you're lending to a company rather than an individual. But the steps that's got to be taken there has got to be very careful. So just coming on to stamp duty, final bullet point there, because that's the other tax to consider when moving an existing portfolio in. And I'm not talking about the 3% surcharge here, I'm just talking about SDLT generally. That is treated as a purchase by the new company of the houses, so normal rates will apply. Whether or not the 3% supplement applies depends on number of properties, valuation above 40k, etc. The only time that that's not the case is if currently you're in a partnership with your personal ownership. And the only reason for that is that partnerships have their own stamp duty tax code. And from experience, I would say, if you're deemed as to be a business for what we talked about with capital gains, i.e. activities being carried on something more than passive buy-to-let, you're probably likely to be a partnership, assuming that there is two people involved, of course. You're probably likely to be a partnership for SDLT as well.